be looking at some opportunities across the yield curve. But before we do, I just want to kind of lay a little bit of groundwork here. This is kind of how I feel about interest rates. I think there's this big box of traders, and most people out there are trading things like stocks and ETFs and options and maybe even cryptocurrencies. And there's this really small group of folks who trade bonds. And they're often considered, I think, a second tier asset class for traders and investors. Traditional, like actual treasury securities are reserved for big pension funds and banks and institutional managers. And then there are some ETF proxies and then some bond futures out there. But it's really like a select club. How do you feel about bond traders and interest rates in general? Is it kind of a nascent asset class still?
Couldn't agree more. It's so odd. For years, I think we're saying, but your portfolio, you were sold by a portfolio advisor, 70% stocks, 30% bonds. If you thought the market was high, you'd go 50-50. That was the extent of a lot of people's bond exposure, buying a bond fund that someone would manage. I think the bonds are traded in price, and it's incredibly confusing for the self-directed trader because the inverse relationship of yields to price. Why price? Well, for an institutional trader, price equalizes duration, credit quality, and duration, credit quality. What's the third leg there?
Coupon that we're talking about?
So bonds traded in price. So that limits people, because if I buy something and I think what I'm trying to trade with the yield is the inverse relationship, it's just very difficult. It's the learning curve of a new product. When you look at 30-year bonds at CME or 10-year notes or 2-year notes, they're all traded in price. It's the way institutions trade them, not the way you and I trade them. If I'm trading an ETF or stock and I buy it, I expect it to go up. If it goes down, I lose. Bonds in the institutional world are all in that price component. It's not something we need or want in the way we trade. So I think that is why the world shrinks. I want to be able to trade things. When I say understand them, understand if I'm buying what I expect to happen and if I'm selling what I expect to happen. We all live in the world of yield, whether it's student loan, car loan, mortgage. That's the way we look at it. How many percent of yield is something to borrow or to earn interest on if I'm putting money into the bank or whatever? That's the challenge, and that's what makes it very difficult. You list all these things to trade, and crypto, is it confusing? Well, it's not. In the crypto, it's a different asset. If you don't get too deep in the weeds, it's the same thing as stocks. If you buy it and it goes up, you're killing it. If it goes down, you're not. So that is the problem with adding bonds to the portfolio up to the point where small exchange came into the landscape.
Yeah, it is kind of interesting to say that like crypto is almost easier to trade than bonds. And I don't think this group of people who trade bonds is so small because people aren't interested in bonds. I think that if you're reading the news any day of the week, especially now that we're in a pretty interesting moment in time with high inflation numbers and some unusual Federal Reserve activity, I think most people want exposure to interest rates and bonds, but the existing products that are out there are just so convoluted. You would expect if you want rates to go higher, you would buy the thing, right? But unfortunately, for a long time, it was quite the opposite. And then there was just enormous size tied to a lot of these products. TLT came into the game, a few years back. I think that opened up the opportunity for many people to get exposure to interest rates. I managed a fixed income portfolio in my university, in my college university. And we traded TLT and IEF and SHY and some of those because we couldn't buy a 100,000 face value bond. But you could get a little bit of exposure in the ETF market. But I think what is really interesting today is how these rate products are moving. I mean, you opened the news over the last year and you saw a lot of headlines covering the price action in Bitcoin. And sure, that was an exciting move in Ethereum as well. But you compare that to the price return in 2-year interest rate yields, Bitcoin almost looks quiet, right? We've seen it almost 300% appreciation in 2-year treasury yields compared to the measly 125 in Bitcoin. And I think a lot of people were concerned or not sure how to talk about the rate activity because there wasn't really a way to play it. You
Right.
can go to any crypto platform and buy Bitcoin, but where do you go to trade 2-year treasury yields?
Yeah.
Finally, there is a place at the small exchange, and we've seen it personally being at the exchange, people taking more interest in treasury yields because it is such a hot opportunity right now. I mean, you look at a long-term chart of 2-year yields, which I'll throw to in this slide here. We're at unprecedented lows, and I don't use that term very often, but I mean, look at this thing. 2-year yields have been as high as 7%. They were sinking at basically 0% for at least 2 years, and they're finally picking up off the ground, which is presenting a really unique opportunity because there's finally a tradable product for it. What's your take on 2-year yields here, Pete?
You know, the context is great. I think you go back and you look here. What's normal? Is it a 3.5%, 4% 2-year, especially if you went back a little longer? I would say between 2 and 3/4, 3.5% is kind of the base. So are we cheap? Absolutely. Have we moved? I love the context you have. We've had a huge move up. Are we still cheap? Absolutely. A 2-year rate of 50 basis points, 52 basis points is very cheap to the whatever we want to call that wide average is. Let's just say 3%.
Sure.
Very, very cheap still. But you know what? We've also moved, as you've shown, a huge amount from 18 basis points up to 52. I'm inclined to think here's a market that really offers you two-way action, and it hasn't for a long time. We've seen kind of a pre-COVID normalization of the 2 years. We saw it move from 1%, 2%, 3%, and then COVID hit, and the Fed just went from, was it 175 basis points for Fed funds down to 0 to 25 basis points in 2 big moves. So that drove the 2-year yields down. Now we're starting to see a little bit of normalization of what the Fed is doing in terms of buying, the idea of rate hikes in the future being priced in, and we're seeing the 2 years come off this pegged low. So you look at this chart, you think, boy, they're awfully cheap, and they're still low. They are. I'm inclined to think that there's still two-way action here. Because if we look at a chart with a little bit tighter time frame, we're going to see that we've had, as you said, what was it, 300% up move? We've had a dramatic up move, and nothing, no matter how abnormal this looks at these lows, nothing moves in a straight line. And you can see from January 2012 to 2016, did we have a good range? We did, from 25 basis points up to 1%. But there was a huge amount of back and forth, wiggle in those lines. So are we cheap? Yes. Are we rich for the amount of time we've moved off the lows? Yes, too. So what does that tell me? Is that there's trade on both sides.
Yeah, that's a fantastic point. And finally, a product from the small exchange, these 2-year interest rate futures, you can take a more medium to long-term stance in yields. I mean, looking at the context that I've outlined on the slide here, but there's also some really neat opportunity on an intraday basis. Just yesterday alone, we saw a huge outside move in 2-year treasury yields. I think they moved something around 90 ticks. So 90 ticks, $90 in the small exchange future. An average day in that product is 19 ticks or $19. So on a medium to longer term basis, you can definitely see we're far below the average for 2-year treasury yields, and maybe we're setting new averages each and every day with this interesting Fed policy, or we'll revert back. But then also on a shorter time frame, you have a product now that's $88 to trade, showing a 20 tick range, or on some days an outside move of around 100 ticks, and you can play off of those highs a little bit. We're still not even close to that 3% level we saw just a few years ago. But coming off of a 300% rally since the start of the year, there's a whole ton of potential back and forth action in this product. So I think, from an investor perspective, you have a unique opportunity in this outright 2-year. And then from a trader's perspective, you have a smaller product. You don't have any pattern day trading rule. And there's plenty of short-term scalping opportunity in this, what we call knot of the treasury curve, which is largely being influenced by Fed activity. So that's, I think, a really unique perspective and opportunity in short-term rates. But we can also finally, with this interest rate product suite from the small exchange trade things like spreads and
Yes.
curves. When I was at university managing this bond fund of ETFs, we spent a lot of time talking about curve spreads. And I think anybody who reviews macroeconomics or is following whatever Wall Street Journal or Bloomberg has heard of this treasury yield curve. It was pretty tough to do with ETFs. As you mentioned, Pete, we were looking to duration match and to consider convexity in fixed income asset pricing. There's a lot of outside complications that retail traders shouldn't have to worry about. But we always wanted to trade rates in context of the curve. Right. Sure, you can take an individual position in 2-year rates, but what's really interesting to me is the relationship between different knots on the curve. So I've plotted here this knob spread, this notes over bonds, 30-year interest rates minus 10-year interest rates. And we can see that even this has been whipsawing. We've seen a pretty decent flattening in this knob spread since middle of 2020, maybe start of 2021. The difference going from 80 basis points or 0.80% down to 0.4% here. That's 40 basis points. Kind of an unusually flat level. I think normally we would expect this difference. The average here is somewhere around 1%. Going back to 2008 between those 30-year and 10-year interest rates, now getting to a very interesting price extreme. What do you think about this knob spread here, Pete? Outside of 2 years, these 30s and 10s really move with a lot higher correlation. Do you expect us to put in new lows or?
That's a great point. And you always hear about yield curve inversion. That would be this chart that Mike's showing going negative, and that would just mean that longer term yields are lower than near-term yields. Often, theoretically, it's talking about as being a precursor to recession. I don't know if that holds in this environment. Maybe it does. Maybe it doesn't. The equity markets say no. They're not buying it. So, I think another tradable opportunity here. Here's the thing. If you buy a bond, traditionally you buy a bond to earn interest from it, to earn yield. Well, we can see here, whether we're looking at 2s or 30s, the amount we're earning in what we call a nominal rate is very, very low. So owning a bond, I don't know how interesting it is right now, short of a place to hide, and I don't even know if it's a good place to hide. The trade of yields is something different. It's a diversified set of occurrences. So looking at this 30s, 10s is very interesting. And to do it previously, Mike, we had to create a ratio trade that not only challenged our idea. What I mean by that is things could move within that ratio that had nothing to do with our bias or idea and cause that position to either lose or make unrelated to what we were trying to accomplish. So, here we have an instance where you don't have that. You have a simple way to trade the difference in these two yields without taking into any ratio here. Because, my trading of these now has become 1-to-1. Do you have a different view on if I'm trading the knob spread, the difference between 10s and 30s, I'm doing these 1-to-1. I know guys like to, have more 10s because they move less. It's a different kind of trade. There's nothing wrong with that. But I think if I'm going to keep this simple, I'm doing a 1-to-1. What's your take?
Yeah, I'm with you. I'm in that same position there. It used to be like something like 3-to-2, or it was like you would look at the ratios for the traditional products and it was never perfect. It was never clean 1-to-1 or 2-to-1. It was like some impossible number that you could never get. And there was that unnecessary wiggle of external factors kind of messing with your position outside of the yield because you were trading the price there, right? I love the simplicity of this whole suite of products from the small exchange. Everything you can do 1-to-1. Sure, if you want to consider the volatility, although actually the volatility, as we saw and talked about earlier this week, it's not always true that 2 years move less than 10s and 10s move less than 30s. So I think one way to maintain just the cleanest exposure is to do these ratios 1-to-1, especially now with how flat the curve is. Right. Maybe if things were wider and 30 years were 5% and 10 years were, 3%, then you'd want to adjust there. But given how flat the curve is, I think the most direct way is 1-to-1. And the cost is so low. I mean, you
Right.
compare it to buying shares of TLT where you're going to put up 50% or 100% of that product's price to get, your exposure. You lay that against, I don't even remember now what the 10-year interest rate product is in the ETF world, but you quickly come to a position that's thousands of dollars
Right.
just to get exposure to the yield curve. Here, you're putting on two positions. Let's say you wanted to trade this flattener or steepener. You'd be buying or selling one of the 30-year and then buying or
Right.
selling one of the 10-year. Total margin is less than $700,
Right.
barely $699. But that's pretty darn cheap to have exposure to one of the largest asset classes in the world. So definitely a sigh of relief, I think, for myself and many people who want exposure to rates, but also a really interesting opportunity outside of stocks, outside of metals or oil, because when you pair these two together, that's really all you're trading exposure to is the difference between two interest rates. You're not stuck to the stock world or what foreign exchange rates are doing or what metals are doing. And actually, you're a little bit protected from what the Fed does because, as I mentioned earlier, that 2-year correlation to 30s and 10s is much lower than you might expect. It's not in the 90s, not even in the 50s. It's even lower than that. So when you trade that spread, you really remove exposure to a lot of outside factors. So just an overall neat opportunity that we wanted to put in front of you guys today.
Absolutely. And you know what, Mike, this removes the complexity of, I know exactly whether I'm long or short this spread, whether or not I think, yields are going to flatten to zero, or I think this yield curve is going to bounce from its lows. I know exactly what I'm getting into. I know what will determine whether or not I win or lose. Mm-hmm. And I think that's an important concept when you're starting to trade rates. Rates are truly, they're the glue, the engine that drives everything. The cost of money is the key component for everything, whether that be currencies or equities. So adding yields or interest rates as part of your tradable stable is really an important piece. So it's a great piece of context there, Mike. Looking at what we've done all week is look at the big picture, get a little bit more granular about the tradable opportunity, and find some interesting ways to express an opinion. So thanks so much for including me in this.
Absolutely. Thanks for being a part of it. And we'll be right back with an episode of Splash into Futures where we'll dive into the platform and maybe look at some of the opportunities in interest rates. But thank you, everybody, so much for joining us for today's edition of Small Stakes. We'll be back in just a moment. So hang in there and see you soon.